In today's video, we're going to break down how to trade internal range liquidity to external range liquidity using a continuation model. Most traders understand the basic framework. When price trades into internal range liquidity, the objective is to position for a move toward external range liquidity. That idea is sound. However, where many traders struggle is in execution. They only want to take a trade directly inside the higher time frame internal range liquidity. And if their specific entry model does not form there, they simply watch the move happen without them. But that is not the only way to approach the cycle. If you truly want to maximize opportunity, you must understand how internal to external liquidity movements operate across multiple time frames, not just one. Everything begins with time frame alignment. When price trades into a higher time frame internal range liquidity, your execution time frame must be proportionate to it. For example, you cannot identify a daily internal range liquidity and then drop to the 1-minute chart for entries. That creates unnecessary exposure to noise and significantly increases the likelihood of avoidable losses. Each higher time frame has appropriate execution windows beneath it. If price is trading into a daily internal range liquidity, your execution should typically refine on the 4-hour or 1-hour time frame. If price is trading into a 4-hour internal range liquidity, your entries should come from the 1-hour or 15-minute time frame. If price is trading into a 1-hour internal range liquidity, your execution should refine on the 15-minute or 5-minute time frame. And if price is trading into a 15-minute internal range liquidity, your entry can be refined on the 5-minute or 1-minute time frame. When you go significantly lower than these proportional time frames, you disrupt structure and expose yourself to unnecessary drawdown. Now let's return to the continuation concept. Most traders focus exclusively on entering inside the higher time frame internal range liquidity and targeting the higher time frame external range liquidity. That works when your model forms. But what happens when price enters that higher time frame internal range liquidity and your specific pattern never presents itself? Do you abandon the entire cycle? You don't have to. Within every higher time frame internal to external liquidity movement, there are smaller internal to external liquidity cycles forming on the lower time frames. The market is fractal. As price expands toward higher time frame external range liquidity, it simultaneously creates internal and external liquidity objectives on the lower time frames. This is where the continuation model becomes powerful. Instead of forcing an entry that never formed, you allow the higher time frame bias to guide you while you refine execution on a lower time frame cycle that is unfolding within it. So when price does not give you your specific entry model from the higher time frame internal range liquidity, you can then shift to a lower time frame, for example, the 15-minute chart, and frame an internal range liquidity to external range liquidity cycle there. From that point, if you identify a 15-minute internal range liquidity forming in alignment with your higher time frame bias, you can refine even further. You can drop to the 1-minute time frame and wait for your model to form inside that 15-minute internal range liquidity. Once your entry forms on the 1-minute, your target becomes the 15-minute external range liquidity. Notice what is happening here. Your overall narrative is still coming from the higher time frame context. The higher time frame bias has not changed. What has changed is your refinement. You have aligned with the higher time frame objective, frame the opportunity on the 15-minute internal to external cycle, and then executed with precision on the 1-minute time frame. In other words, you are not abandoning the higher time frame story. You're simply executing through the lower time frame structures that exist within it. This approach allows you to participate in the expansion toward higher time frame external range liquidity without being dependent on one single entry location. It prevents you from watching complete cycles unfold without you and instead teaches you how to operate within the continuation structure of the market. When you understand time frame alignment, fractal liquidity cycles, and proper refinement, you stop thinking in single entries and start thinking in structured narratives across time frames. That is how you truly maximize the internal range liquidity to external range liquidity cycle. Not by forcing trades, but by maintaining bias, aligning time frames, and executing with precision within continuation structure. So this is the example we're going to walk through. First, we can clearly identify an internal range liquidity, and we can also see that the external range liquidity was eventually taken out. Initially, this presents a very straightforward narrative. Once price trades into internal range liquidity, we anticipate a move toward external range liquidity. Now let's move forward and break this down. When we transition to the 4-hour time frame, we notice something important. Price does not actually give us a clear entry model. Many traders would be waiting for a liquidity sweep, followed by a market structure shift, and then a return into a fair value gap to execute the trade. However, in this case, price simply expands to the upside without delivering that ideal sequence. At that point, most traders would step aside and allow the move to unfold without participation. Sometimes that approach is acceptable. However, it is not always the most efficient way to capitalize on the cycle. If we refine into the 1-hour time frame, we can identify a small fair value gap that technically could have been used for an entry. But when we apply the risk to reward tool, we immediately see that the setup is not attractive. It does not provide up to a 1-to-2 risk to reward trade, which reduces the quality of the opportunity. So again, many traders would simply let the move run. And while that is understandable, there is still a better way to approach this situation. Notice that both the 4-hour and the 1-hour time frames failed to provide a clean, high probability entry. But when we drop down to the 15-minute chart, something very interesting begins to appear. As price was expanding toward the higher time frame external range liquidity, the 15-minute chart was forming its own internal range liquidity to external range liquidity cycles. This is the first one, this is the second, and here is the third. What this shows us is that even within a higher time frame, internal to external liquidity cycle, there are multiple lower time frame internal to external cycles forming along the way. The market is fractal in nature, so whether you secured an entry inside the higher time frame, internal range liquidity becomes less important. Why? Because as long as price is still operating within that broader, higher time frame cycle, lower time frame opportunities will continue to form. However, once price trades above and completes the higher time frame external range liquidity objective, the opportunity to trade this specific continuation model is no longer valid because the cycle has been completed. Now observe how a precise price action was on the 15-minute chart. Price trades into a 15-minute internal range liquidity and pushes upward. It then retraces into another 15-minute internal range liquidity and expands again. It repeats the process one more time before finally reaching the higher time frame external range liquidity. Each of those 15-minute internal range liquidity areas provide an opportunity. From those zones, you could refine execution by dropping to the 5-minute or the 1-minute chart to wait for your model to form within that 15-minute internal range liquidity. Your target in that case would be the corresponding 15-minute external range liquidity while still maintaining alignment with the higher time frame objective. This is the key takeaway. You do not have to depend on price delivering a perfect liquidity sweep, market structure shift, and fair value gap directly inside the higher time frame internal range liquidity. If that specific pattern does not form, you can allow the lower time frame internal to external cycles to develop within the broader, higher time frame structure. From there, you frame your trades around those lower time frame cycles, execute with precision, and continue targeting expansion, all while remaining aligned with the original higher time frame narrative. That completes the first example. Now let's move on to the second example. Let's look at this example. Here we can clearly see that price created a higher time frame internal range liquidity cycle. Now the question is, what if you missed your trade from that level? What could you have done differently? The simplest solution is to drop down to a lower time frame and wait for price to form its own internal range liquidity to external range liquidity cycle within that higher time frame narrative. For example, on the 4-hour time frame, we can clearly identify a 4-hour internal range liquidity here. We can also see another 4-hour internal range liquidity forming right here as well. Each of these areas presents a continuation opportunity within the broader higher time frame cycle. If we refine further into the 1-hour time frame, you will notice multiple examples of the same concept. Here we have a 1-hour internal range liquidity, then we have another 1-hour internal range liquidity here, and another one formed here as well. Each of these structures can be used to frame a valid trade idea. The key point is this: you do not need to panic or feel discouraged if you miss one entry. As long as the higher time frame narrative is still in motion, you can always refine into the lower time frames and wait for a lower time frame internal to external liquidity cycle to form. That lower time frame narrative can then be used to position yourself back in alignment with a higher time frame objective. However, there is something very important you must always keep in mind. The lower you go in time frame, the lower the probability of that internal range liquidity holding. So while lower time frames provide additional opportunities, they must always be traded in alignment with the higher time frame bias and with proper risk management. We are going to stop here for today. If this video was impactful, give it a thumbs up and subscribe. See you in the next one.